Now, for more on today's market action, we're joined by Mark Grant. He's Managing Director of Southwest Securities. He's also the author of Out of the Box and Onto Wall Street, Unorthodox Insights on Investments and the Economy. And also we have with us Stephen Wood. He is a senior portfolio strategist with Russell Investments. They manage a mere $180 billion. Gentlemen, good to have you with us. Mark Grant, I want to start with something that you wrote today in your Out of the Box column. You were talking about how too big to fail now means too big to bail out. What did you mean by that?
Well, Europe has been able to bail out Greece and bail out Ireland and Portugal, but we're now right at the verge of having to bail out Italy. And as a matter of fact, I'm going to make the call today that I think that's coming. It's not going to be very long. And I think the majority of the reason for that are the political missteps that have been made in Europe, so that they're not going to be able to fund the tremendous debt that Italy has. Stephen
Wood, come in on this. You were listening to Mark Grant, and you're sort of wincing here. I mean, give us your perspective. You're salt of the earth from Wisconsin, a good Midwesterner. I mean, have we reached a point where things are just too big to bail out?
I think so. That was a Cheesehead agreement with his observation. It's a very large market. You're looking at the third largest bond market on the globe. So, I mean, these are very, very large numbers. And I think what we're finding out right now, all the political shenanigans aside, and Europe, the inability to arrive at a meaningful decision aside, governments are just very small entities compared to markets. And the world between 3% in Italy and 6% is dramatic. And the numbers don't really work out at 6% or above in terms of funding costs.
But Mark Grant, isn't there an emergency stability facility that's set in place in Europe? And haven't the AAA rated countries such as Germany already said, we'll backstop it?
Well, Pimm, that's a misnomer in a sense. They do have $440 billion that they can use currently. They have a plan to increase that, but there's been no monetary action put in place. They have various other programs that they can use with this now, but this has to go back to all the parliaments in Europe, all the governments that use the euro, and they are months away from getting that passed. And in the meantime, they had a tremendous difficulty with the last Spanish funding. The Greek, the Italian market is not only the third largest, it's the second largest bond market with $1.8 trillion. And also, Pimm, they've got a tremendous problem that their GDP, their debt to GDP, is 120%, which Greece only has a higher debt to GDP ratio. And I don't think at this point they're going to be able to fund, and I think that Europe is in real trouble.
Stephen Wood, a race to the bottom? I mean, if Mark Grant is correct and Italy becomes the next victim of its own demise, what does that mean for U.S. investors?
Well, I think that safe haven still comes to the United States. You got the big three currencies nobody seems to like a lot, but you got the yen, which has its own problems, the euro, which we're discussing right now. So the dollar, in that ugly pageant of the big three liquid currencies, you know, we could come in a last place. So what you're looking at for a solution in Europe is you really have to have kind of a United States of Europe with a centralized Ministry of Finance making all these fiscal decisions. And Mark's right. I mean, this is going to take years of treaty ratifications. This is not weeks or months we're looking at. So right now, the U.S., I think, in terms of our equity and our bond market, I mean, we're the deepest, most liquid, most dependable game in town.
Mark Grant, a 5-year high in the amount of cash on deposit at the European Central Bank. More people putting their money in cash in Europe. What does that tell you about where they think the future is?
That tells me that people and institutions in Europe are fearful. There are also other indicators showing that the interbank lending is drying up. You're losing liquidity. This is the same kind of thing, I point out to you, Pimm, and all your viewers, that happened right before the Lehman crisis. People got afraid. People locked up money. The system stopped working in an adequate fashion, and then all hell broke loose.
Stephen Wood, Italian bond yields, Spanish bond yields at 14-year highs. What's it going to take to deal with this problem? I mean, do the bondholders really just have to take a haircut? Does someone say, look, you made a bad loan, sorry, take the pain, we've got to move on?
it gets into a credit rating and default risk. So is that contagion? The European policymakers, if you can call them that, thought they had it contained. That's the whole idea of Greece, is to kind of stop that from spreading, and clearly that was not the case. So in terms of getting private bondholders to take a haircut, that's going to really depend on what the European Union wants to see their credit rating go as. I mean, again, do we get that United States of Europe? Do you get Euro bonds, which draw upon the full faith and credit of the entire European nation? Then you're into a transfer union where you've got the richer nations, which are sending money to subsidize the lifestyles of Club Med, as it were. Now, is that politically viable? So there's a lot more questions than there are answers. But ultimately, I think that, in the United States, we can make decisions if we choose to. It's kind of sloppy process, but we can actually do something. The United States is not illiquid, and we're not insolvent. These southern states are bordering on that. So that really is a different calculus for this side of the pond versus that side of the pond.
Mark Grant, European banks, now they typically are going to what? Issue short-term U.S. commercial paper in order to fund their operations. What's up with that market?
Well, that market is being rejected by the big U.S. institutions. I do want to say something. Steve made the point earlier, and I totally agree with him, that there's no question in my mind that the United States, whether you're in debt, whether you're in equities, wherever you're doing, is a much, much safer place to invest money right now than Europe because of these tremendous problems over there. But the short-term market, Pimm, is basically rejecting European bank debt. They don't want to carry it anymore. They feel like it's too much risk. And we're seeing this across the board in the debt markets every place in the world right now.
So, Mark Grant, what are the risks that European banks are faced with, and could that also be a risk for U.S. banks?
No, it's not nearly as much risk, Pimm. If you look at, for instance, the Italian debt, the big owners of Italian debt are in Europe. The United States only has $14.8 billion in bank exposure to Italian debt. It just means that I think more and more money will flow out of Europe, out of Asia, back to the United States. I think it means a stronger dollar, though that market is very concocted right now by China and by Europe. But eventually, the markets are much bigger than any government on the planet.
Stephen Wood?
Well, and also look who would take the haircut in Europe. Who holds these sovereign bonds? European banks. So when you're looking at German and French and British banks, they got exposure to Greece, to Italy, to Ireland, to Portugal. So who would take the haircut? So from the German position would be different than the French. So they owe it to themselves. So the haircut would really be felt. So is it solvency of the banks? So it's not as easy as finding private bondholders to put the costs on. It's very, very interconnected, which used to be a benefit of being in the euro.
Right.
Now it's the Achilles heel.
Well, that interconnectedness, I want to get a little bit more about that. Mm-hmm. Does this mean then that interconnectedness means that counterparty risk is a conversation that's taking place all over Europe right now?
Oh, absolutely, absolutely. And you saw it in the short-term money markets and the funding costs. And when we were in 2008, it was kind of like this Where's Waldo game, Try to find the toxic asset because everything was so structured and so complicated. You didn't have the ability to know who had what. Now, in Europe, it's a little bit more transparent. We do know who's got what, but the answer is not something that people like. And there's a lot of this debt being carried on balance sheets. A year and a half ago, the stress tests, they weren't really tests and they weren't very stressful. They didn't even count sovereign debt, which were the toxic assets of Europe, in their calculations. So now that we have that in the equation, the solvency of banks are being called into question, which is your previous point. So the funding liquidity is drying up.
All right, so for U.S. investors or investors anywhere in the world, look to the United States, particularly to the corporations that are showing good profit growth.
I think so. You and I were discussing at the break, corporations in America look very strong. Earnings will slow down. They will decelerate, but off of all-time high levels. It can't go on forever, but it can go on for a good long while. Companies are ultimately going to trade off of three things: the economy, interest rates, and earnings. The economy doesn't look very good at all. We're teetering on the edge of a soft patch, if not something a little bit more serious. But interest rates and earnings look pretty darn good.
Last point to you, Mark Grant. What's the next date that we need to pay attention to right now for Europe?
Well, the next date we need to pay attention to is the next funding for Italy, which is coming up shortly. I think that they're going to have a tremendous difficulty funding. Actually, I'll tell you, because I deal with a lot of very large institutions. The ECB will buy bonds. They'll run the yields down going into the auction. They'll have the auction.
We've got to leave it there, gentlemen. Mark Grant, Stephen Wood.